Hi everybody, Stuart here again. Sorry about that. The recording wasn't working and I couldn't find it, so sorry about that delay. Welcome everybody. Lots and lots of new people in here today. There's many names I don't recognise, so I'll run through things as quickly as possible. Hopefully everybody can hear me, and we'll crack on as quickly as possible. So today we're going to be talking about multiple time frame analysis. It's something I've used many times. I always look at the high time frames when I'm taking my own trades, and hopefully you'll understand why we do that today. So if there's any problems with the broadcast, it's usually sometimes a problem with GoToWebinar, the software, or your local internet connection. So try restarting the software. Any questions, any problems, email us at webinars@hotforex.com. This is me. My name's Stuart. I should actually show you the disclaimer before you look at my ugly mug. So before we get going, this material is provided as a general marketing communication for information purposes only and does not constitute independent investment research. Nothing in this communication contains or should be considered investment advice or an investment recommendation or a solicitation for the purpose of buying or selling of any financial instrument. All information provided is gathered from reputable sources, and any information containing an indication of past performance is not a guarantee or reliable indicator of future performance. Users acknowledge that any investment in FX and CFD products is characterized by a certain degree of uncertainty, and that any investment of this nature involves a high level of risk for which the users are solely responsible and liable. We assume no liability for any loss arising from any investment made based on the information provided in this communication. And finally, this communication must not be reproduced or further distributed without our prior written permission. Okay, so that's the admin out of the way. Just a quick introduction to me, because there's lots of new names in here. I've not heard my dulcet tones before, so thank you for your time today. My name's Stuart Cowell. I've worked in the City of London for nearly over 20 years. I work for retail banks and investment banks, but more importantly for this position, I've been trading with my own money, investing since 1997, 20 years in September, in fact. And over that time, I'd say I could distill the 4 key things that I've learned, or that I would, I can't recommend what you do, but my experience falls into these 4 key areas, and the 4th one being the most important in my view. So the first one is do something that's probable. If it seems right or it feels probable, do it. So keep probability on your side. There's plenty of time, there's plenty of opportunities, especially in the Forex market. The Forex market is open 5.5 days a week, 52 weeks a year. There's always an opportunity to come along, so there's no rush. It's a marathon, it's not a sprint, this game. Also keep it simple. Don't clutter your charts with lots and lots of indicators. Don't try and understand every single piece of news that comes out. Don't try and understand every nuance or announcement that's made. It'll just drive you mad, and you can't do that. Keep it simple. If you understand it and it seems probable, do it. If it doesn't, don't do it. It's as simple as that, because there's lots of other opportunities coming along, and over time you'll see your pattern of behavior and your trading pattern sort of falling into a certain way of doing things. The other thing, time frames. We're going to talk about a lot about that today. Multiple time frames. I always look at what's going on in the lower time frames as well as what's going on in the higher time frames, depending on the time frame that you're actually trading on. So that's what we're going to talk about today a lot. But the most important thing for me as a successful trader, or to be a successful trader, is to actually know yourself. So you've got to understand your risk levels, or what sort of person you are. Are you the sort of guy that can, or lady that can sit and be a scalper, in and out very quickly, do lots of trades in one day? Or are you the sort of guy that wants to look at things at the end of the day after the markets have closed and just look at daily candles? It's all about you, how much risk you're prepared to accept. Also, can you accept losing? Many people come into this business thinking it's only concentrating about the winners. If you concentrate about the losing trades, because they happen all the time, and you can accept losing, you can move forward. If you can't accept losing, you'll never get off first base. And I can't answer that for you. You've got to look yourself in the mirror and decide what sort of person you are and what sort of time frames you can trade on. But that's a webinar for, I could talk about 2 or 3 hours about knowing yourself and time frames and psychology, because this business is very much a psychology business. In my view, it's 80-90% of it is about you, not the markets, not your broker, certainly not anybody like me talking to you about the markets. It's about knowing you and your risk levels, and risk management is by far the most important thing. But as I say, that's a webinars for a different day. We're going to be talking about multiple time frame analysis today. It sounds complicated, but it's quite straightforward and it sort of makes Sense. Hopefully it makes sense. So today we're going to look at the principles of MTFA, or multiple time frame analysis. We'll look at the news if we've got some time at the end, which we should have. We'll look at some trades we've had open, my approach to trading, a trade we've just opened this morning, and one I'm about to post actually. So you've got a heads up here on this Euro Aussie trade or position I'm going to post. My books, those of you that haven't been here before, people are always asking me about, do you recommend a book or a course or a website? There's many books about trading, and then we'll go through those if when we got time at the end. Okay, so before we get going, can I just have a quick show of hands or a click on the question window? How many of you have been or completely new, have been trading for less than 3 months? There's lots of new names in here. There's lots of you I recognize, but there's lots of new names as well. So how many of you are brand new to trading this? Okay, lots of new ones and lots of new people. Okay, just complete 3 months. That's okay. 3 months, 3 years. Okay, Safik, I've seen you before, I think. 2 years failing Disney on live account. Okay, that's not uncommon, Jimmy. Don't worry about that. Okay, good. Great, thank you. Any more before I move on? Okay, all right. So, thank you for that. Okay, so there's quite a mix of people and lots of new people I don't recognise. So we'll talk through multiple time frame and how it can help you. The key thing, if you've been trading for more than 3 months, or you're still in business, that's great. There's an old adage in trading, or 90% of people fail after 90 days and lose 90% of their money, the 390 rules. I don't believe in that, to be honest. If you know what you're doing and understand yourself before you risk any of your real hard-earned money, you can make a success of this business. If you stick to understanding yourself, stick to some simple rules, don't get greedy, don't get scared, you can definitely make a success of this business, because it's all there for you. It's just about understanding yourself more than anything. So best of luck, everybody. I say multiple time frame analysis. Let's crack on with today's topic. So what is it? It's a way of following the market with at least 2 time frames, or resolutions. If you see this in American literature, they call it resolution. So it's 2 different time frames. So whether that's 1 hour and 15 minutes, 4 hours and 1 day, 1 day and 1 month, it doesn't matter. Basically, the key thing is that the higher time frame, the dominant trend in the higher time frame, and you time your entries with a slower time frame. And I've got lots of examples we'll go through. Past ones, but a live one from yesterday as well for the trade that we took on the pound and the yen. It fit both scenarios, interestingly, yesterday, so that was good timing. So it's very much a top-down approach. So it helps you to focus on the main trend, the dominant trend, and trade with the prevailing momentum. So the key thing to recognize as well is a market in a trend. Markets do they do 3 things. They go up, they go down, which is a trend, or they go sideways. Mostly markets, especially Forex markets, can go sideways for 60-70% of the time. Conversely, they tend to trend about 30-40% of the time. But trends in Forex in particular can go on for a long time. Look at the British pound, for instance. After the big fundamental news of the Brexit vote, sterling, the British pound, the GBP, has been going down against most other currencies for quite 6-7 months. So that's been a very simple trade. Certainly against the US dollar, it's gone. It was at 150 and it broke 120. So it's a big move in those months. So it's a very strong, clear downtrend. So trends can go on for a long time, but also, excuse me, markets can go sideways for a long time as well. So it's knowing when a market's in a trend. So we use the longest time frame for identifying the major support and resistance levels. So if you've got a big, support level or resistance level in your monthly or your weekly chart, that can be much more significant than a support or resistance level in a 15-minute chart. I hope that makes sense, because it's all about the higher the time frame, the more significant the support and resistance level can be. And then we use the smaller time frames for getting our entries. If in the smaller time frame it actually gets to those higher support and resistance levels, that's a good area for entering sometimes. So sometimes you can end up you not just using 2 time frames but 3 time frames, just to, if it's not clear on one, you can drill down a bit further. So if your higher time frame was, say, your daily chart, you drilled down to the 4-hour time frame, you couldn't see anything clear, drill down to the 1-hour time frame sometimes, and that clarifies it. And similarly, if 4-hour, using 1 hour down to 15 minutes. So it's just a matter of deciding on the time frames that you want to use, and it tends to be those sort of time frames. Okay, so what is it all about? So it's all about finding sort of peaks and troughs in the market. We call it here the pivot high. So what is a pivot high? If we decided where we found our trend. So prices, they're historical turning points, where the energy of the market has run out. It's been running in a trend in one direction and it just can't get any more. There's no more buyers to take it high. So demand is greater than supply, price moves higher. That's simple economics. There's more people wanting to buy apples in the market and there aren't very many apples, the price goes up. Once there's lots and lots of apples in the market, the price comes down. It's as simple as that, and so it is with financial markets, and that's all it is. It's as simple as that. Don't overcomplicate things either. That's the other thing many people do when they come into this trading business. They try and overcomplicate things or read too much into the market. Keep it simple, keep it probable, and understand yourself, and I say you can be quite successful at this. So pivot high. We have the price moving up. 1, 2, 3, whatever this time frame is, it doesn't matter. So we've had candle 1, candle 2, candle 3. The price has moved up 3 consecutive time frames. The wick's quite tall, couldn't get any higher, so it's closed here. It got as high as here, opened here, closed here. Is it going to go? Is the fourth one going to go even higher? Well, no, the fourth one tried to go higher, so it opened a bit higher, but it actually closed over that period down here. So it pitched up, but it didn't get as high as the previous high, the candle 3. So candle 5, again, it's rolled over again. So the energy in the market, the buyers have run out of dominance, and the sellers have slipped in. So we've created this little peak, this pivot high. So pivot high is created when historical price point is at least one lower value either side of that pivot point. Okay, so we get this like mountain peak or pivot point, we call it, and we call it lower highs either side of the pivot high. So as you can see, 1, 2 was up, 3 was the highest, 4 was below 3, and 5 was below 4. So we've created this peak. And guess what? Pivot lows are the exact opposite of that at all. So how do we apply that in a moving market? So we're looking for these pivot highs all the time. So here, excuse me, the blue line is the trend we may have identified, but what's going on? Okay, so pivot highs, support and resistance levels in an uptrend. When an up move is in price is rejected and price moves considerably lower, a pivot high is created. So what we've got here, think of the waves on the ocean or the wind blowing over the ocean. We create our first big wave, our first movement up. So price moves up, hits a level, and it reverses down a bit, but it doesn't reverse as much as it did from where we started from. So just like a big wave coming into the beach, it sweeps in and then the backwash takes it out, but the backwash isn't as big as the main wash as it comes in. So the next move is up again through that level where we were before. So what was a resistance level in the first move has been broken, and the new high comes up here. And so this little diagram here, if we broke down the candle pattern instead of just the line, we could see these pivot highs being formed. So again, here we've moved up to the second point. The wash has come back. We've got reversed a little bit, but we didn't reverse all the way back down to either 0.2 or 0.3, but we did reverse back down through 0.2, which was interesting, wasn't it? But for not very long. We only broke it a little bit, and we broke it and then broke back through it on our next move up. So we've had one move up, two move up. The third leg takes us above the previous. So what was resistance may now indeed become a support area, because that's an interesting zone, isn't it? We've got these two inverse positions. So here we've got a pivot high, here we've got a pivot low, both around the same sort of levels. Okay, the next move, the next leg up, not as big as the first two, but it's still a move up. The reverse wasn't as big as the move upward. The reverse wasn't as big as the move upwards. So we're still moving forward, still moving higher, and we didn't reverse to this point. So we're above this zone. So this becomes really interesting there now. Also, what we've got here, somebody can't see my pointer. They're saying, "Oh, I'm on the I'm on the wrong screen. Sorry. So let me just do that again very quickly. So first move to the pivot high, second reverse, the reverse of the first move, not as far back as the first one. The second move up was higher than the first resistance level, so we broke through that. The second move backwards actually broke back through this high point, so this becomes interesting, this level here. So what we've got here after this third move up and reverse, so it's formed the same thing. We've got lots of things going on here. We've got a zone here which was a pivot high on the first move, is now a pivot low on the third move down. And also we're starting to see this trend. We can start now draw this trend because we've hit this line once, twice, and now 3 times. The interesting on the third touch is that it's higher than the previous two, so we've got a trend going here. Prices are going here, so this becomes an interesting level. That's what we're looking forward to. And look, the fourth move up bursts through this resistance level here, and lo and behold, it reverses back to this level when it actually reverses again. So we've had move up, move up, move up, move up, reverse back, reverse back, reverse back, and we're moving up, creating this trend, creating this zigzag movement, and price up, reverse, price up, reverse, price up, reverse, price up, reverse, and on we go. So that's a strong trend. So, and each of these reversals are in the same sort of zone, except here we had a pivot high, here we have a pivot low, broke through that, but that area, that the red line that was resistance, is now support. Resistance, the red, comes to be support on this move here. So by the time we create the trend line the fourth time, we're much higher, strong trend running, and so this should keep, well, looks like it could keep going because of the strength, and there's obviously lots of other indicators might help us suggest where to get in on this move. Okay, so it's as simple as that, and try and keep it that simple. This is very simplified because it's a big black line and a clear blue line, and the candles aren't in here, but that's the basis of it. Okay, I'll go through this a few other times again, but it's the same thing. It's the same movement whether you're moving up or moving down. This is pivot high for stop and reverse levels in an uptrend, and so the principle is just turned on its head when we're coming down. Okay, I'm sorry I was talking to myself before on the wrong screen. So lo and behold, a pivot low is the exact opposite. You literally turn it on its head. So guess what? This time we're going down. Red candles. Well, it doesn't matter what colour the candles are, but we're going down. So candle 1, we're here. Candle 2 is finishes lower than candle 1, and candle 3 finishes lower than candle 2. Try to get all the way down to here. There wasn't enough sellers there, and buyers came in and took us back up when we closed here, still lower than we opened on candle 2. So what's happening? Oh, candle 4, we tried to get lower again. No more energy to take it down. We didn't get as low as we did on candle 3, and then we actually finished higher than candle 3. So we've gone down, we've bounced back up again. So here we've got supply greater than demand. Things are going down, prices are going down, until we get to a point where nobody else wants to sell and the buyers start coming in. So 1, 2, 3, 4, we're back moving up. Have we got a pivot low? Well, it's looking that way because the 5th candle is finished higher than the 4th candle, and the low is here, down here at candle 3. So instead of having lower highs for a pivot high, for a pivot low, guess what we have? We have higher lows. So the lows on candles 1, 2, 4 and 5 are higher than the low of the pivot low on candle 3. Okay? And honestly, it's as simple as that. And when you look at your charts, you'll, these sort of things, these pivot highs and pivot lows, don't jump off the chart at you. It isn't there, is what I say to people. Some people say, how can you identify all this? Well, it's not just because I've been staring at candle patterns for a long time. It's very, very simple, and that's the beauty of candle patterns, and that's why the Japanese were so keen we brought them over to the West, and that's why the Japanese were so good at trading and have so many great trading indicators. But the candles is a particular easy way, graphical display of what's actually going on. So pivot high, pivot low, and that's all there is to it. So just as we were going, the energy when we were going up was stronger as demand was greater than supply. Here we've got supply greater than demand, and we've got exactly the same principle. As support becomes resistance, resistance becomes support. So let's just do this again. So first move down, big move down, smaller reverse back. Second move down, bigger than the first move, breaks the support area. Big move down this second one. The reverse of this second move was back to the zone we were in before. So whereas before we had a pivot low, here we now have a pivot high, but it's, look at that, it's hit that point as well. We've got, is that a trend for me? We don't know yet, do we, at this point? We don't know if that's going to go back up that way or keep going down this way, because we can't see, and that's the beauty of technical analysis and the art of understanding the charts, is that we never know what's going to happen on the right-hand side of the chart. The right-hand side of the screen is always blank, and the art of technical analysis and our understanding is trying to work out what's probable, what's probably like to happen. So we've had our 1 move down, 2 move down, our 3rd move down in reverse takes us back to this level, but it's lower than this resistance level. So we might be able to draw this red line, trend line now, because we've hit it 1, 2, 3 times. Oh, that's interesting. So that line should extend there, shouldn't it? We could now predict that this is going down here. So, and that might be why this one's such a big one. So the 4th move down, sorry, 1, 2, 3, 4th move down is a big one, and it goes lower than our previous low. So we broke that. So quite possibly, when we were coming down here, we could see that we'd already drawn this line. So this could be a good reverse area. We could have already anticipated this being a possible reverse area, given that this trend line has been hit 3 times. So we definitely seem to have a trend. So as this big move down here, this new low here is going to reverse a little bit, and it's quite likely to reverse to this trend line, and that's quite often where people start to get in, or at this point here, because it's quite possible, probable, that we'll come back to this area that was support resistance to the move down here. The blue line now becomes support to the move down again. So lots of buyers may have got in there, and off it goes again. So it's the same sort of thing. It's zones, not exact numbers, but these are areas, about zone areas, and then you apply other indicators to sort of back up the theory sometimes. Okay, but multiple time frame analysis allows you to do that. So this is the higher time frame. This is how a trend develops. Excuse me. So so uptrends, price pulls back from a former pivot high in the daily time frame. We're looking for intraday opportunities. In the downtrend, the same thing. If you're using the daily pivot high, you then drill down to look for opportunities in the lower time frames, in the 15-minute or the 1 hour or 4 hour time frames. If you see this strong daily level or weekly level or monthly level or whatever your higher time frame is, becoming, you know, support or resistance. So there's some examples here. So here we go. So same thing, just it builds up a little bit more slowly. So 1, 2, up we go. Price pulls back, so resistance becomes support. Reversing around these pivot points, we're looking at the lower time frames. So we're looking at these levels all the time. Now that we've identified, excuse me, after 3 touches here, sorry, I'm on the wrong screen again. 3 touches here, we've got our blue line now, we've got our daily trend, and the intraday charts are coming up to this daily trend line. So it's really strong support and resistance levels here. And so it's quite straightforward to look for the little pin candles, the little reverse points, the pivot points, the turning points in these time frames. Okay, so honestly, it is that straightforward. Don't overcomplicate it. Don't look for too much detail, and sometimes it will hit you quite quickly when you're looking at multiple time frame. This is a real example back from, I think this is back from 2014 when we put the slide together. It looks a little bit complicated. This is from eSignal, just a different service provider, but obviously you get the same sort of view with your MT4 platform. There's other things going on here. If you can see as with all technical analysis, it's not just one used in isolation. So it's not just multi-time frame analysis used in isolation. Use some other indicators as well to help you keep you at the right side of the trade. So this particular example actually includes quite a technical format, which is the triangle here and the breaking of the pinnacle of the top of the triangle here, because the technical analysis theory says if once a triangle has been identified and it's broken, the travel distance is usually the distance of the long side of the triangle. So the theory says that if that breaks, like we've got here, the distance from here, this line here, is usually that distance there. But we'll see how this builds up. So this is the it doesn't really matter what it is, but it's the US dollar CAD, and I say it's back from October 2014. So the key one is this level here, the 1.142825. So 1.428. It's a pivot high from November on closing basis, coincides with the 23.6 Fibonacci retracement. So here we have this level here. So this is running through November. We ran up to this Fibonacci level here, 23.6 at 142, and then we drifted away from it, we retraced back from it, back down to here to 12780, back here, this zone here. But it was the bottom, happened to be a channel as well. See the blue lines, it just happened to be the bottom of the channel as well. So we had this triangle forming as well, and the width of the triangle was this point here. At this point here at 1, suggested that our target would be 115.44 from this breakout here. Okay, so this was just it. We didn't need, no, this is all the candles were telling us. Down here the stocks were, the stochastics were also saying it was a potential trade as well. So we're looking for corrections to this support line here when we come back down here, and this is what actually happened. So this is the triangle here. So we had our target up to here, this 115.44 level, the break of the triangle. And so what we were looking for was it to come back to here to give us an entry to take it as up to here, and this is what happened. Here we've got, it ran to this level and it's come back to this 23.6 stochastics Fibonacci level as well. So it ran up, it touched the 23.6, sorry, it touched as it broke out of the triangle, it ran to the 26 immediately. It hung around it for a little while. It ran up, ran back, came back down to it, tried to go back down to the 38.2, didn't, and that's another great entry point to run this up to this target here. It's also down at the bottom of the Bollinger Band. So further, this is a 4-hour chart. So down on the 15-minute chart, you can see we got some entries at this level. So this 4-hour candle here has been broken into these 15-minute charts. That's the price here, the blue dotted line. So we're getting these little pin bars to suggest, with long wicks, suggesting strength in the lower time frames. And these are our entries here, or even here. This is a really good. This would have been a good one as it came back up to it, and we were pretty confident it was going to break up. So we've got the triangle. We've identified our target from the triangle, the break of the triangle up to here, this target here. But we were waiting for a retrace as it broke out of that. So it ran up immediately, ran out of energy, came back, and it coincided with a Fibonacci level. It couldn't reach the next retracement, and so by the time it came back to here, we were fairly confident that was going to then run off up to our target, and in fact beyond, as it did. So that was our target here, and it's run off beyond. But the entry levels have been given at the lower time frames, and I'll show you, say what I did yesterday on the pound yen. Is that making sense? Somebody's saying they haven't got any audio. Can everybody hear me? Yeah, everybody else can hear me? Now, I've run through that quite quickly. Has that made sense, or has that confused people completely? All good, says Jimmy. Anybody else? There's lots of you in here. So good, lots of goods, okay? Good, okay. Hi, Ghazi, good to see you again. I understand, good. Okay, the other thing is I can speak a bit too quickly, so if I'm speaking too quickly, I'm not explaining things properly, ask me to slow down. But I'm, I get very enthusiastic about this subject, and I want you all to do well, and I'm here to help you, okay? So hopefully that made sense, okay? What time is it? It's, let's have a look, 40. Let me just run through another example. So everybody's clear. I won't go through these again. These are similar slides we had before, okay? So it's just basically identifying the trend and looking at the lower time frames to look at an entry when the lower time frame gets up to that, or close to the higher time frame resistance or support levels. I won't, if you don't mind, I won't run through that S&P one. It's a bit complicated, okay? But let me do it quickly. It's the principle's exactly the same, okay? So we've had this wrong. This is an example again from 2014. This is the S&P. So it's a stock market. So this works on all assets. So we've had this long run up in the stock markets back in 2014 and. Good, Ghazi. I'm glad to hear that. I'm in touch as well. So we've had this long run up in the S&P, and bit of a rollover, came back down. Look at that. It was actually a Fibonacci level as well when it stopped. But let's we're not talking about Fibonacci today. It was more the multiple time frame. So what is this telling us? So we've had a run up and a retracement, but we're still in a long uptrend. So the uptrend is maintained. But as it came down, the market's oversold, but there's no signs of reversal in the daily time frame. So we've strength up, some big candles moving down, some key moving averages it's hit as well, coincidentally, the 51 there, the red one. But what opportunities are there? So drilling down to the lower time frames, we can see these daily lows providing support and resistance. The resistance areas here was here at 2009 level, this 2009 level, which was also the 23.6 Fibonacci level, coincidentally. Okay, and it's weird how the Fibonacci levels coincidentally hit key support and resistance levels as well. So the Fibonacci level actually fit with the daily low. So we're looking to go short again. So as it's rolled over, this is the lower time frame, so we've run out of energy, we've come down, we've bounced off, we've come down to the 38.2 Fibonacci and had a big bounce, but then a big break back down to it. So opportunity to get in here at this 23 level, and then we've done the same thing at the 23.6 level, another opportunity to get in here at a lower time frame, and that's what happened here. So here we can see as we've come back down to this 2009 level in the lower time frame, the 15-minute time frame, we've gone through the 2023 level, we reverse back to it, but we know that's going to be a resistance level because of this, the uptrend has broken. And look at that, what a great little pivot high that's created there. So even if you didn't get it on this one, exactly this 209 level, that would have definitely been an area to get in, and then we've run down to this lower level here, and then it's broken that again. So it's done the same thing. See how it's come down in steps? 2023, 2009, and then down here as it's hit this sort of 2000 level as key support area here. How the lower time frames have let you get in there. So it's very much about knowing, you know, when is a trend in place, is a trend not in place. The key thing about identifying a trend is if it doesn't look clear on the screen, or on the, you can't see it clearly on the chart, you know, it's probably not in a trend. Okay, don't try and look for things that aren't there, or try and make, you know, a trend line fit something just because you're looking for a trade. That's another not a great idea to look at when you're trading as well. So it's all very much about trying to keep it simple and looking for what the big high time frames are doing compared to the lower time frames. Okay, so we're gonna is there any questions at this point? Does that make sense? But again, the time frames don't matter, but if say when I'm trading, I use the monthly, the weekly, and the daily. If you're trading intraday, use the daily and then use the hour and perhaps the 15-minute. Or if you want to trade more, you can look at the 4 hours, your higher time frame, and then perhaps the 1 hour and the 15 minutes. But you'll see as you and even then you can drill down lower, down to the 5-minute if you want to. You'll see these things repeating themselves time and time again, because that's what the markets do. They repeat themselves time and time again. Okay. Can you move the slide back one step, says Faisal. Okay. Did you mean to this one? Okay, yeah, there's a couple of questions coming here, and they're about on the same sort of time. Faisal, did you mean, which slide did you mean, Faisal? I'm not quite sure which one you meant, because I skipped through a few here because I'm running out of time. Yes, Omid, that's a very good question. Omid's put a question in here. Sometimes when I see a 4 hour, which is an uptrend, but the daily chart says another word. The thing about multiple time frame analysis is, she lets me, I'll bring up the demo account, my trading account in a minute. The thing is that the higher the time frame, as I said at the beginning, the more significant the support and resistance levels are. So a support and resistance level that you have identified on a monthly chart or a weekly chart is much more significant than a support and resistance level you might find on a 1 hour chart. And that's exactly what this multiple time frame analysis is. If the 1 hour chart or the 4 hour chart gets to a key support and resistance level on the daily chart, then that becomes a good strong support or resistance level. Okay, so why 250 SMA used? That's just what I've always used, Ghazi, and it works for me, and it works for me, so there's no reason for me to change it. That's all. How do I recognize the time frames when the markets are trading sideways? Well, Tharto, take a step back, okay? Zoom your chart out and see, is there a trend, or are we going sideways? If we're going sideways, that's when you want to be using your oscillators and your, sorry, there's nothing on the screen. I was just going to bring this up. So your oscillators and your indicators that work more appropriately in sideways. Somebody's saying they can't hear anything, but it might just be at your end, Nagwasi. Okay. So let me just, this was from yesterday. Okay. Can everybody see the MT4 platform? It's a bit messy now, but let me sort of zoom in. This was from yesterday. Good. Okay, so when I posted something on Friday. I don't know if you've watched the, if you follow me on the analysis page. Hopefully you do. We'd had a movement down here in, this is the pound yen, or the guppy, or the widowmaker as it's often called. We'd had a big move up during November, December, beginning of December, and then the pound had weakened as the yen was strengthening. So we'd had this, the second leg down, another move down. So this is the daily chart. Okay, so this, remember, I look when I'm looking for opportunities or for trades or stuff to write about on the website. I only look at I start at the daily chart. So what we've got here is a up move and a down move. We've got the big thick red line, which is the 50-day moving average. The thick purple line here is the let me just take that off. Let's take that off. The red line here is the 50-day moving average. The purple line is a more significant 200-day moving average. We'd had this move down, and last week we'd identified this. I'd identified this bottom. It wasn't quite a tweezer bottom, and again we'd had this trend line broken up, and then it come back to it, and then it broken up again. So that was looking like it was going to go up. When I looked at this on Friday, which is this day when I was looking at it, we'd had 3 up days. So again, nice strong candle pattern. Those of you who followed the candle stick pattern, we'd had 3 up soldiers. We'd had Mrs. May talk. The fundamental was Mrs. May talking about clarifying the Brexit situation. So the pound had strengthened, and so we'd had these 3 up days, and that was really interesting for me because the key thing was on the Thursday it had broken and closed significantly above the purple line. See how the close is up here, significantly above the purple line. So that was that was spiking my interest, as I say. Okay, the resistance higher is the thick red line, and indeed the shorter time frame, the 20-day moving average, because these are the Bollinger Bands here. This is the top of the Bollinger Band, the middle Bollinger Band, which is the 20-day moving average. Okay, and the bottom of the Bollinger Band here, which it burst out of. So that was the bottom. Even though the Bollinger Bands are still pointing down, I was expecting some sort of retrace. Up at the higher time frame, so that's of interest to me. I would say normally, a safer trade would be to enter would have been the break of this 20-day moving average on the daily time frame. Okay, but because the daily time frame would create this very strong support here at the 200-day moving average at this level here, 141 about 15 I've got here. Okay, so that was a strong level for me, 141.14. And look also how it coincides with the recent move down. So this is so we put a little Fibonacci retracement on here, and it retraced straight through the 23, but it's stuck at the 38.2. So this is 2 lots of strong support here. We've got the 200-day moving average and the 38.2 Fibonacci level. So this will be a strong level, whatever way it is, whether it's support or resistance, but it's proven to be support at the moment. So that spiked my interest on Friday, and you could look for entries on the lower time frames with this as your support area, or this is where it's going to come back to. Okay, so this is the daily time frame. So let's drill down to the 4-hour time frame with that thick line here, the 141. 14 on there. Can you see that? This is the 4-hour. Okay, so Friday is back here. So here, Friday 19th. So see how this 200-day moving average, the strong one that we marked on the daily time frame, has provided support in the 4-hour time frame. And the top is this 142. So we've got a bit of a channel forming here. So it's quite a straightforward, buy here, sell here, those sort of trades. And many people would have been doing that during that time frame. Yes, it breaks it occasionally, but these are good entry points. And the entry points are these smaller pin bar type candles that gives you entries. So that's 4-hour. That's looking interesting if you only wanted to look at every 4 hours. See how it's supported it. More or less 1, 2, 3, 4, 5, 6, 7 times 4, all day here, supported by this strong 200-day moving average, 141.15. So even lower down at the 1 hour candle, still got the same level. Sorry, I'll wait till that refreshes. So we still got the same level here. This is obviously the 1 hour candle, so they're a bit spikier, and we're only we're going back to the 20th, which was Thursday, Friday. So again, we've got this support level. So yesterday, when I was looking to get, I think we got in. Yes, there's a blue dotted line where we actually got in. This was the one that I was interested in. I think it was about 3 o'clock yesterday. Where are we yesterday? It was this one, wasn't it? 3 o'clock. Was it 3? No, here. Sorry. Sorry. Right. So yeah, it's because this is 1 hour candle. So this again was, yes, it's spiked below it, but remember it's held quite strong, and the 38 Fibonacci level. This is still the same Fibonacci level how it's held, and this is the 200-day moving average. So they're within, quite close to one another. So our entry was here. I didn't actually get into that. That's right. That was the one that's I'd looked at in the morning and meant to take it there. We didn't. It rummed up and it came back down to it here, and we didn't get filled till this. So we got actually filled at this point here, whatever that price is here, 141.14, I think, or something like that. So big up day, big hour, big down. So it's gone down a little bit, but it's still going sideways because this key 200-day average is still 200-day moving average is still providing support even down here at the 1 hour time frame. So you can see even when we haven't got a trend here, okay, even when we haven't got a trend here, that 200-day moving average is actually providing support. So your question, who was it who was asking about sideways movement? This is what it can do. So the trend might be, pointing up, pointing down, but here it's going sideways, but it's still giving us entries at these lower time frames because of the strong purple one here on the daily time frame. Okay. At the higher time frame, what I've done today and what I've posted today is, I've got in a wee bit early, and we might end up getting taken out. But once it breaks this 20-day moving average and this 50-day move, look how the 50-day moving average actually coincides with this 50-period Fibonacci level. So there'll be many people looking to perhaps trade that to that level. It may fail, it may not fail, see what happens. The 200-day may or may not support, but it's likely to take that. And the reason that that's likely is because, and so my target's up here at the 61 Fibonacci level, not too far away, not too greedy. It's, again, based on my target was based on the ATR, and again, those of you that have been in other webinars know that I like the ATR, the 14-day period ATR. So the 14-day ATR is 1.83 or about 188, I think it was yesterday. So I was looking to get in here at the 142 level. 142 and a little bit, 0.1 plus 1.8 takes us back up here to this 143.8 level, the ATR level, and it coincides with the 61 Fibonacci level. So that's looking quite probable. Okay. It may or may not happen because of this strong support, this strong potential resistance at the 50-day moving average, and ideally you'd want it to break for a safer entry, break this 42 level at the 20 period moving average for a safer trade. Okay, but I've taken that anyway just as a demonstration of how multiple time frame analysis works in real time. So instead of looking at charts from December 2014, this is from yesterday. So you can see how you can do this all the time yourself and see how opportunity in the higher time frame with these clear, strong support levels allowed lower, trades between the levels as well. So here we've got so bouncing between the levels, quite straightforward, quite comfortable, sort of trades on the lower time frame, on the hour time frame. Okay. So hopefully that makes sense with a live trade that is actually open now, based on the principles I've just talked about drilling down, looking at the higher time frame as your main direction, and then drilling down to the lower time frames to get intraday trades if that's what you want to do. Now remember, I'm trading off the daily time frame, so for me, I'm always interested in the higher time frame. So here, the reason I'm quite comfortable to take this to the ATR plus a little bit more, this 180, 200 position point move, is because the monthly time frame has clearly broken this downtrend it's had, and now we're going back up. So the monthly time frame looks like, well, I'm saying this, we've had a big up move here. It looks like it may have found this bottom at 128.50 level. So, it looks like it may be returning. So I'm with the longer term trend. 1, 2, 3 months have turned around. So it's sort of turned that trend potentially. And the weekly is still a bit weak. So we've still come down. Sorry, the weekly's come down, down, up. It may have run out, but again, it's this strong support here at the 140 level. So again, we're looking to go up. So the weekly isn't as perhaps clear as the monthly, but remember the monthly's higher. So I'm comfortable with this big candle here that we, it may go sideways, but we could see some more strength in the British pound and the Japanese yen there in the longer term time frame. But so that's actually with the trend, that one. Okay, so does that make sense? Is that the sort of thing you guys could do yourself? Because that's what you should be doing. No answer. Okay, somebody's asked about a stop loss. Well, the stop loss really, ideally, should be back down here at 136. So you could argue, well, that's that. The risk reward is quite small, because if we got in here, we're only trying to get here, but the stop loss is all the way down here. That can be the case, but really the stop loss could be here because of this strong, because the 200-day moving average is such a strong support area. You could probably quite comfortably put your stop loss here, or even here if you wanted to be really secure. Remember, this was the big uncertainty about the British pound in particular. We were really, really uncertain about what was happening. That sort of clarity has been, that uncertainty has been taken away to a degree from Mrs. May's speech. So we've had this run up last week, and then I'm expecting some more positivity up this week. Okay. Vincent, it's not a live analysis workshop, but Vincent's asked, can we do some live analysis? What I can do for you, Vincent, is give you a bit of a heads up of something I'm going to post when I close this session now with you. I took this trade this morning on the Euro Aussie, very similar to the pound yen, because we'd had this big move down, big spike down. This is Euro Aussie again. This is earlier last week. Bottom down here again. Again, look how the Fibonacci levels fixed it. However, this one is against the trend. Okay, so I've got in here. Last night's close was the trigger. So we got in here, and it's right smack bang on this 23.6 Fibonacci level. And I'm going to take it was about 100 pips on these sort of against the trend trades, and it just happened, coincidence again, and it's amazing how coincidence fits these Fibonacci levels. It lines up nicely with the 38.2 Fibonacci level from this high here on the end of the year, the 23rd. That's the 12th of the 30th of December. So we've had this move down, little Fibonacci retracement. Again, it's not a tweezer bottom, but the bottom is very similar to the bottom we've had on the pound yen. One of the caveats on this one is that if you look further back, you can see that the lows are actually getting lower. 1, 2, 3, 4, 5. So the lows are getting lower. So this could be a simple, just a little retrace. It may not get there, but it looks like it hopefully should get up to this sort of level before it starts going down again, because with this one, the monthly time frame is still very much down, as you can see here. That's that. See the dotted line here on the higher time frames, and you can see that this bottom 1, 2, 3, 4 is quite strong at this sort of 140 level. And again, look, it's this round significant psychological number at 140. So this could break, or it could provide support. It's provided support 1, 2, sort of 3, 4 times. So it's looking like it could, tick up and then have support down here again. This is the monthly, and the weekly also is still a strong down trend. So we've still got some fresh air down here. It could come down to here, this the sub 140 level back here from March 2015. So it's a bit of a looking against the trend, a little bounce up, but I'm only looking to gather about 100 pips here as we go up to this 142 sort of area. And I'm going to post this on the website later. So take profit is 142.90, I think, Garcia, on this particular Euro Aussie trade. Okay. I do post daily, Amiola, normally, yes. So that's what it goes. I mean, it's there. Follow it. It's for you. I mean, I'm happy to keep talking if people are happy to stay, but I appreciate your time. Is urgent, is important. If people are happy to stay, I'm happy to keep talking about things. You know, it's been a quite fundamental, significant week with obviously the new president. There's been a big significant Brexit discussion. The new president has, caused the dollar and the stock markets to weaken. Some other news coming this week, but I'm run over my hour, so I'll quickly finish with this is what's on our website, the live analysis. So we've had a really 100% start to January, which is obviously it will come to an end at some point, but we've had that one was a intraday one, so 1, 2, 3, 4, 5, 6 trades, 6 winning trades, and they've all gone on to target 2, most of them. This last one was the FTSE. That's a bit ambitious, that's 7 times what we'll see, but 1,200 pips, 15 pips. Just simple daily trades, daily markets, low risk entry, target's not too far away, but worth the wait. So here, this one was open on the 4th. It hit target 1 and target 2 on the 9th within 5 days. This one, we opened it the 4th. It hit target 1 on the 11th and then target 2 on the 12th. So momentum kept going. This one was on the 9th. 2 days later, it target 1. By the 16th, it got to target 2. This one was the 11th. The next day, it hit target, and then 5 days later, it got to target 2. So the principles are there. This one's still open. We're short the euro, British pound. It's probably a little bit, that target's probably a little bit excessive, I think, because it's actually against the trend. I took it as if it was with the trend, so I may we'll see how that one's going, but it's still in the money, that one. But and then there's that pound yen one I talked about just now. I've posted, and this one I'm about to post after I finish here with you guys. So there you go. You get a heads up for joining me today ahead of the market. Jimmy's asking, any fancy to the parabolic SAR I see you use often? I don't know what you mean by fancy, Jimmy. The parabolic SAR, right? So let me just answer this question, and then I'll take a few more. The parabolic SARs are just a trend following. So parabolic SAR support stop and reverse, it stands for. So parabolic SAR, stop and reverse. Okay, not support and resistance, but support, stop and reverse. So they're these simple blue dots here. So they're great when the market's trending, like you got here. When it starts going sideways, it's not so great. So here, as you can see, they flip from one to the other. So when they're above, the market is generally going down. When they're below, the market is generally going up, but they can flip. See how that one, we had that little run up here, and then it flipped to the above before it flipped down, and then it went back up again with this huge spike. So they're not, like as with any indicator, nothing is perfect, but you just add them all together and get them to work for you. So here here's a good example. It was still short here, but the market was going sideways. So they're not great when we've got sideways movement. That's when you want to look at your oscillators. But when you've got a strong trend, they keep you the right side of that trend. So here, for instance, this Euro Aussie one, the parabolic SAR has yet to flip. So I've perhaps you could argue that I've jumped in a bit too early on this one. So it's still in a downtrend. So it would need to perhaps go up here before that one flipped. But not everything. If you wait for everything to line up 100%, you'll never take a trade. So you just got to make a judgment each time you take a trade, because you could argue this one Euro Aussie is quite negative. The Bollinger Bands are still pointing down. The parabolic SAR hasn't turned. The RSI is at 41, which is quite negative. So there's lots of negatives for taking that trade. Okay. So it's just this for me overrode those negatives at the moment, but we'll see if it doesn't break above this 23.6, I might end up getting stopped out, and it returns to form these new lows, and it ends up way back down here, and we end up stopped out, and it's a losing trade. But that's part of trading, that's part of the risk. But if you're not risking too much, if you know that this level is only going to be 1 or 2% of your account, if you do get stopped out, it doesn't matter, because you know when you do get things right, you're making more, basically. Okay, so it's all about risk and reward. Okay, right. Gracious just says, I just started using the Fibonacci retracement yesterday and it's working great for me, but I don't really understand it. It gives me a better intuition. Can you briefly explain it for me, Gracious? Well, that's exactly how I use it, actually. When you read the Fibonacci books, you read you watch. I've got a webinar on Fibonacci. You'd watch the webinar, or you listen to anybody else talk about Fibonacci. And the question that comes every time is, well, where do I start it? Where do I start it and where do I end it? Well, it doesn't matter, is what I say. So long as you've got a trend, it doesn't matter. So here, I've only taken it back to this peak because this is the latest leg. And it's weird how it fits in. You could, the longer Fibonacci on this whole screen would be back here. So let's do it now. Let's see what, just this particular time frame, the high is there. And we've got a downtrend, haven't we? And the low was there. So in this higher time frame, we've gone from here all the way down to here. But we've got these other lows here. But see how this might sound a bit strange, but see how the 23.6 from the higher time frame coincides very closely with the 38.2 on this time frame. And that's not the weirdness, but that's the wonderfulness, if you like, of Fibonacci, and that's why it's so easy to use, and that's why lots of people use it, and that's why lots of these levels get hit a lot of the time. A criticism of it is, well, there's lots and lots of lines on there. You get 4 or 5 lines each time you run a Fibonacci, so it's bound to get to one of those lines. Yes, it is. So what I do, I tend to put my own put my own support and resistance lines on first, and then add the Fibonacci. See how it fills in with what I'm wanting to do. Like I say, this Euro Aussie trade I was talked about, I only put the Fibonacci on after I'd actually thought, well, this is about 100 pips, and it just coincided, so that added to the decision making. And remember, see the dotted lines. This is the downtrend still. So see how that downtrend hits this level as well. So that's a third indicator that this will be a point of resistance. And it also looks like it also crosses, look at this one, it crosses the 50 and the 20-day moving average. So there's lots of resistance at this level at 142.90, or which it will be, it'll be 143. And again, it's a round significant number. So you've got all these things confluencing here, like all these rivers are coming together to create a mighty Amazon. You've got the green line, the red line, the downtrend here, that dotted line, and the Fibonacci levels. It's going to take a lot of energy, a lot of momentum to get through this level. So why not get out at this level? And lots of people will be doing that. If it gets to that level, it may come back down there. You don't know. That's the risk you take, and that's what trading's all about. Okay. Hangwelis, but the signals on the previous spreadsheet, do you share them, or are they just your personal trades? No, those trades, everybody, and not just Hangweli, they're actually, they're on the website. Let's just try and pull that. These are what the dates here are what's posted here. So if you go to, oops. So if you go to, oh dear, I need a cup of tea. It's past my lunchtime. So if you go to the website analysis.hotforex.com, which I can do for you in a minute, you can you'll see them there. So here is our website. This is the analysis one. This is the one I've just put on this morning. Sorry, has that come up for everybody? Guys, are you all right to hang on for it? I've gone over the hour, so 5 more minutes. Everybody happy to stay? Everybody's still in, so I guess you are. So they're on here. So this is what I've posted this morning. So check this every day. Make it part of your, not that I want you. It's for education, okay? It's not. I'm not saying do this. This is what I've done basically, and this is explaining what I've done and the words, you know, like entry points, target points. But I say, you know, 1,218 pips there in those 6 trades. So there's some logic to this. And if you go to the home page of that, they're all here. So this was the FTSE trade we talked about earlier in the week. So this is when did we enter this one? This was last Wednesday, the 18th. So we were with this one. Can everybody see the FTSE chart? With this one, strong down candle. That was enough to get me in here at this 72.40. And I thought there was momentum was going to take it beyond the 20-day moving average, and indeed it did. And it hit that yesterday, 71.55. And the key thing for this, if you're following the FTSE still, my target 2 is down here. As I say earlier, it was a bit ambitious at 7,000 possibly. But the fact it's broken this 20-day moving average and it's still below that today, I think, I'll bring that up in a minute if I can find it, will mean that, indeed it is, means that that weakness is continuing. So this is where we got in here. That's why we took our profit yesterday, this one, 71.50. Can everybody see that again? Sorry, I'll wait till it refreshes. The fact it's broken, see this strong, see the 20 period moving average here? It's been above this since when? December the 5th. So this is a significant break for the FTSE. Can you see that? Look at that strong up move there. Didn't get to the top of the Bollinger Band. It rolled over, big move down on Mr. Trump's inauguration. Protectionism, worried about trade, so it affects big companies. So we've had this big move down. Now the fact we've broken this in itself, the fact that it's broke the 20-day moving average will trigger a lot of other automatic trades. And as you can see, that's what happened today. You can see how the gap formed. And that's because technically the robots, the automated systems that just wait for levels, wait for prices, have seen that that gap's been formed or hit or broken, and they've opened close. So yesterday, big gap on open on Monday, you know, quite a big tail on there. So there's some strength there potentially, but again, we're down today. So that's generated lots of other sell positions perhaps. And that, look how that is coincided with that gap there as well. So this gap here sort of could be filled. See how it's sort of been filled, but just by the wicks pushing it down. There's no more sellers on this one. See that? See how the big long wick yesterday on the FTSE? Lots of trying to push it down. It sort of filled this gap here. You know, and again, see how the gap, lo and behold, look how Fibonacci's fitted again. It's about around the Fibonacci zone at 38.2. So this gap is likely to be filled possibly, but the move down, the counter to that is the move down has been quite significant. However, having said that, history shows us and tells us the more you trade, certainly the indexes, the FTSE is a particular one, they go up quite slowly, they grind and grind and grind and grind up, but when they roll over quite aggressively like we've had in the last 4 days. Look at that big move down. So the reason I got in that trade, as I wrote on last Wednesday, was the fact that that one candle here took out 1, 2, 3, 4, 5, 6 previous lows. So in one day, we took out 6, 7 previous days. That's why it was significant. So again, watch my candlesticks webinar, because the bigger the candle, the more significant it is. Anyway, I've talked enough today and I need a cup of tea now, so hopefully that's enough. Will it be possible to stream past webinars? Ingracious, yes. Go to the website and look at all the past webinars are there. So if you click to live webinars, scroll down, click to view our past webinars, and they're all there, or most of them are there. Lots of them are there. So RSI, Fibonacci, targets and stops, our support, structure, who are the real players. Look, they're all on here. Okay, all part of the service. Okay. Thank you for that, Ingracious. Bless you as well. Okay, guys, I'm going to call it a day because I'm running out of energy, to be honest. And you don't really want to listen to me dribble on for hours and hours. That's not fair on anybody. So hopefully you've learned something today. Next week, on Thursday, in fact, Kay is going to be talking about different styles, scalping to position keeping. And then next Tuesday, the last day of the month, we're doing some live analysis again, or a bit more than we did today. And take it from there. I haven't got time to talk about my books, but they're on the slides. If you're brand new to trading, have a look at this book here, Anna Cooling, Forex for Beginners. It explains things really well. She wrote it 3 years ago. But if you only ever buy one trading book, not necessarily about Forex trading, buy this one, The Reminiscences of a Stock Operator by Edwin Lever's story of Jesse Livermore, the boy trader. Fascinating book. Always makes me smile every time I read it. Yes, it was written in 1923, but the markets haven't changed. People haven't changed. Markets go up, they go down, they go sideways. People are made exactly the same as they were, in the 20s as they were centuries ago. It's fear and greed that drives the market. Okay, thank you everybody. Any final questions? Final question, and I'm going to close it. So 2 minutes. Raoul, bearish divergence on a 4-hour chart in the USD, but it didn't work out as the 1-hour chart was already showing that it had been oversold. So on which time frame should I have trusted, 1 hour or 1 hour? Raoul, the 4-hour time, the higher time frames tend to be more significant than the 1-hour time frames, but they don't work all the time. Nothing works all the time, and that's what you've got to get your head around when you're trading. You just got to accept that when you open a trade, if you lose, you only lose 1 or 2% of your account. And you do lose. I've been, January's been great. We've had 6 trades all in a row, but I'm winning about 69%. So I lose 30% of the time, and it's just part of the business. This business, if you get your risk management correct, you can lose, up to 50% of the time, and still make money. But again, that's a webinar for another day. But look, if you're interested in that, have a look at the. And again, if you're new and you've not traded before, the key webinars I would say to look at are certainly the ones I've done, are the ones about mind frame. Let's have a look. Is it on here somewhere? This one here from the 17th of May last year. Successful trading is a mind game, and I do it many times as well, because that's what it is. I'm a fervent believer this business is 80-90% psychological, 10%, 20% method. Okay. Ahmed, yes, thank you. I need to go and get my tea. Raoul, if you want to email me that question, if you're still here, do so at webinars@hotforex.com, and I'll answer you in more detail if you like. Okay, I'll have a look at the time frame you were talking about and see what you are. So that's the. Oops. So webinars@hotforex.com, the one that was at the beginning. Okay, thank you everybody. No more questions, and I will see you next week. Okay, take care. Thanks for your time. Bye-bye.